Hello everyone, my name is Vikas Agrawal and I'm the founder of AIF and PMS Advisors India Private Limited. So as some of you might be aware that we run a show called Ask the Expert. So basically the format of the show is basically to invite the experts from the industry and understand their perspective on the markets and also get an update about what's happening in and around the economy. So today is a very, very special day because we have with us Mr. Taher Badshah. I think he doesn't need any sort of introduction, but for those who are hearing him for the first time, let me take the opportunity of introducing him. So he is the Chief Investment Officer at INVESCO Asset Management. And before joining this, he used to work for Motilal Oswal Asset Management Company, where I had an opportunity to work with him and learn a lot from him. Mr. Taher has worked with various organizations, and one of the largest organizations apart from Motilal Oswal is ICICI Prudential as well. So Mr. Taher brings about almost 25 years of rich experience in the area of investments, more particularly in handling equities. And at the same time, he's engineer. He's master's in finance from SP Jain. So that brings me to my first question. And before I ask the question, so welcome on the show, sir.
Thank you. Thanks, Vikas. Thanks to be on your show, and it's nice to reconnect as well. It's been a long time since we spoke this way. So it's great to be on this platform. Thanks for inviting me.
Sure, thank you. So, let me begin by asking you one personal question, if you allow me, Mr. Tahir, is that, so you are an engineer and then you did your master's in finance. So what made you to get into Dalal Street 25 years back?
So the way I thought of it was, look, I mean, yes, I did start off as an engineer, and it's been a long way back in 1991 that I graduated out of my engineering college. So after completing my bachelor's in engineering, and I specialized in electronics um, and hardware engineering, not as much in software. 1991, and in and around that time, you guys can imagine it was a tough time, both from the point of view of the overall economy as well as in many other ways, socially as well. There was a lot of tension around, and which basically meant that India was pretty slow on the growth path, and opportunities were not there as far as engineers went, unless you had the wherewithal to actually go abroad and study abroad, do your masters or do your more um, more postgraduate kind of courses, if you were to probably have access to those. So if you were able to go for higher studies, etc., then you would that was an option in front of you. But otherwise, you were it was not a very happening time, and it was a kind of a controlled, constrained atmosphere, especially from an engineering perspective. India on the manufacturing front, even at that point in time, was not as it is probably even today was not very strong. Uh, IT services was an emerging industry, but again, that was still it started off more towards 1995 onwards, so it was a little early at that point in time, and so jobs were difficult to come by, and opportunities were not very clear at that time. But when as an engineer, basically we did have reasonably strong analytical capabilities, and I thought, um, uh, I was always attracted to um, doing something which is on the management side, and I did work for a couple of years as an engineer, basically developing embedded software for actually telecom products. And at that time, we used to have these all these PCOs which were proliferating in all parts of the country, and you used to have these nice booths in which you used to go and make calls, and when you dial the number would display on the screen, and then you would get these fancy receipts which would come out once your call concluded, and so on. So the software for that was is what I wrote. Actually, I worked for a firm which specialized in this, and it was exciting. It was a new game altogether, writing code and so on. But it was mainly meant for hardware-oriented products. Anyway, long point short was basically market opportunities were still very limited to come by, and but the drive towards analytical capabilities was there, and After working for a couple of years as an engineer, I got an opportunity to be in business school, and therefore I thought that I should go there. And it is during that time that I got attracted towards the capital markets, and within the several available streams which were there post or options which were there post being a management graduate, I thought financials was something which made sense. Where I thought, and within financials, I thought I would start off as a research analyst, because then I would be bringing some of my engineering capabilities to the fore by being in uh, trying to be a research analyst in sectors which are to do more with industrials or manufacturing companies, and where I understood things a little better, etc. So essentially, to bring my engineering capabilities to the research function. And when I started off looking at equity markets, I looked at it more from the point of view of only analyzing companies and analyzing businesses, not from the point of view of analyzing markets or going to portfolio management. But I mean, so that is how essentially the drive towards and the attraction towards equity markets started. But the overriding and overarching attraction was that it was trying times, and we came from very humble beginnings. So from whatever I could see at that point in time, I felt that ये ये रास्ता ऊपर जाने के लिए सबसे fastest रास्ता है. So I thought that this was the easiest way to climb the ladder and move up. And so I wouldn't make any bones about the fact that that is what was beyond everything else the key attraction. And yeah, then it only got better. I got into contact with some very interesting people who mentored me along the way. Mr. Ramdev Agarwal in particular, whom everybody knows as a veteran of the markets, and I had the pleasure of working with him for a very long period of time. I almost bumped into him, and he, by chance, and he gave me an opportunity to work for him. I almost got a walk-in interview, and that's how I started my career. And this is how. But then one thing only led to another, and it was basically the sheer pleasure of looking at things differently, coming into. It was also over a period of time the whole attraction that look in when you are in equity markets. No 2 days are different. Every day you come in and you'll be doing and confronted with something totally different. Um and the world would change on a daily basis, and your work would accordingly change on a daily basis. So it was not a typical 9 to 5 job, and every day was pulsating, and it kept you alive. So those were the things which I cherish and I love about equity markets, and that's probably what cemented my belief and my resolve that I wanted to be here.
Sure. So the other thing is, which I am more keen to know is, you spent almost 25 years and you've been instrumental in terms of developing the frameworks for various organizations. So what do you think, according to you, which is the best framework you think is good for the investors to create long-term wealth?
No, I think there are so because there are a few frameworks which have been there are a good number of frameworks which are there in the market, and people have, and there are practitioners of those frameworks uh, uh, you know uh, in the market as well. uh, it is not at one level about which framework is the best or which works the best. It's more the discipline of following your framework and following your process. So there are no process is superior over another. If a process is designed in a manner which can work for you and which you are comfortable with, okay, working with on a day-to-day basis and running portfolios or your own money or anybody else's money on that process or on that framework, then that is what you want. It should work for you. It is something which you should have conviction in, and you should have the discipline to be able to implement it and use it on a daily basis. You should not have a process and do something which is totally in contravention to the process, or something which is totally outside of the process. So the key learning, more than which process is appropriate, there are several things which work for different people. There are several frameworks which are right and can have the right conclusions in the market. So um, important thing is to understand that, have conviction in that, run it on a daily basis, do what works for you. That is uh, if it is a framework which works for you, then that is the best framework. Then there might be 10 other people who might be having whom they might claim might be having superior framework, but that is what works for them. You have to figure out what works for you. And if it is fundamentals, it is fundamentals. Maybe if it is technicals, then perhaps it is technicals, or it is a combination of the two, or whatever. It could be a growth oriented framework, it could be a combination of a growth and a value oriented framework. uh, it A framework can be appropriate for people. Some frameworks are appropriate for people who actually are managing personal money or proprietary funds. Managing public money is probably a slightly different ball game, and it has its own compulsions and challenges. And a framework which is probably designed to do that may not necessarily appeal to people who are actually running their own money, and vice versa. So as I said, you have to figure out what works for you. uh, I have had the chance, thankfully, across my career to work with a couple of two, three different frameworks, and all of them in their own place were right place, right time. They were appropriate, and they still work, and they have relevance um, uh, in the environment in which they are working, or in the firm in which they are being implemented. As an investor who aligns himself to one fund manager or one a mutual fund, it is important that the investor thinks uh, or understands what is that framework about, and whether that framework is something which appeals to him or not. Okay, just because the firm is projecting it, or you know is forwarding it is as their investment process, doesn't necessarily make it right for the underlying eventual final investor. The investor has to share the same conviction in the fund manager that, look, what he is saying is correct. And if that manager has actually used that framework successfully over a longer period of time, then he should place that conviction in him, and follow him. uh, uh, but otherwise, just accepting it on face value may probably not be the right thing to do. So I think it is important that uh, investors insist on fund managers, or the mutual funds, or whoever it would be. It might be a PMS manager. They should investors should insist that the managers have an appropriate framework. They should demand what is their investment framework, if at all they have one. uh, Understand it thoroughly, and if you feel confident enough that this is something which is acceptable to you, only then you should actually uh, give them money to manage for you at one level. So to answer your question, there's nothing like a right or wrong process. It's about following it in a disciplined manner, and doing things as per the conviction of that process.
Sure. So at Invesco, you run your PMS book, you run your mutual funds as well. So what is the investment philosophy as far as your portfolio management services is concerned?
So basically, I mean, again, at one level, we recognize the important thing, the most important thing, that we are managing public money, and we are not managing our own money. All right, and there are, like as I pointed out earlier, that managing public money versus managing your own proprietary money has certain nuances in terms of access to capital, in terms of the flexibility or the freedom that you run with, in terms of expectations of end clients versus your own return expectations as a proprietary investor, and so on and so forth. So the framework that we use at Invesco, I would think, is something which is more appropriate to managing money uh, uh, in the managing public money, especially on the mutual fund format. Uh, our framework basically, in fact, we are one of the very few houses, I would think, in the market who actually puts out a proper process document and an investment framework document regularly. I mean, you can visit our website and access that, or in whatever way possible. But we put that out regularly. We update it, and it tells you exactly how do we conduct our affairs on a daily basis, and how do we run our portfolios. In that document, you will find that there is one central part, which is stock categorization, what we call as the stock categorization framework. And this is the framework that the firm has been using ever since its inception in 2008, 2007, 2008. So it's been constant and hasn't been changed or altered in any way or diluted in any way in the last uh, 13, 14 years of its existence. Uh, Maybe we would have probably made it stronger. We would have refined it, and we would have done those kind of things. But we have not diluted the core or changed anything. Even when I came into this firm 4 years ago, around 4 years ago, I haven't changed anything out of that process. Uh, you know, uh, but we have made it stronger, as I said, and we have refined it over a period of time. So the stock categorization framework, in a nutshell, actually, uh, basically, it what it does is that it creates some 7, 8 different categories underneath it, and each of these categories are have a certain description around it with regard to the kind of companies that we want to buy in our portfolio. Each of these categories has a has a description which elaborates as to where is the positioning of that company, where is it in its life cycle, what is the expectation out of that company, what are the financial parameters of that particular company. Uh, these 7 or 8 categories are actually divided into two broad buckets, a growth bucket and a value bucket, because growth and value are the two primary forms of investing. And therefore, the framework at one level allows for growth investing as well as value investing. And we can therefore tailor our products to have a growth component as well as a value component accordingly.
So can we
So
say
what
that,
it does,
sorry to interrupt, can we say that it is more like a GARP or a combination of value and growth? So where,
it is a combination of value and growth. It is not growth alone, because we realize and we understand that our the several strategies that we run under the on the mutual fund format all are not growth oriented strategies. There are value oriented strategies as well. In fact, our flagship fund is a value oriented fund. You might be familiar with the Invesco India Contra Fund, which is a flagship fund, and that is a value oriented strategy. So our framework is designed to meet our requirements, and our requirements is to be able to spot growth opportunities as well as value opportunities alike. But at a very holistic level, what we do is that whenever there is what does our categorization framework achieve? What it does is that whenever an investment idea is proposed by anybody, whether it could be me or my colleagues or the analysts or whoever it would be, uh, that investment idea has to fit into that framework and into one of those 7 or 8 buckets that we have. Okay. At the very outset, when we decide on why we are buying a company, we attach an investment rationale to it, and that investment rationale comes out of each of those 7 or 8 buckets. So uh, even before investing, we have to be very clear that this is the reason why, XYZ reason as to why I'm buying this stock, and it should fall into one of those categories. If it doesn't, then as per our framework, it does not merit a place in any of the funds or any of the portfolios. So every idea has to be categorized. It has to be put into one of those buckets. Three of those buckets are growth oriented buckets. Uh, the other three are value oriented buckets, and there are a couple of them which are basically to do with a bucket called commodities, which is a separate bucket by itself. And there are event based plays, or something which is more special situations kind of plays, which occupies the last bucket. So idea being that at the outset, I identify the investment rationale, follow that investment rationale over the life of that stock in your portfolio. So once you have bought the portfolio for XYZ reason, then keep monitoring whether that stock or that company is delivering on that investment premise that you set out with. If at all there is a detraction from that investment thought or investment premise. So for example, if you expected a company to gain market share and behave as a company which is going to go faster than the industry rate of growth, or it is probably going to expand its margins, then you want to see that company deliver exactly on that same premise. If it does not deliver on that premise, then it basically tells you that it is not working as per your expectation. Stock might be going up, that's a different issue. The price might be going up, you might be making money on that stock as well, but it is not doing the things that you intended it to do, which is a red flag for you, which essentially at one level also may become a signal for you that, look, you need to do something with the stock. Either you need to sell it off, or you need to revisit or reanalyze it, or maybe trim your position or whatever else. But it is telling you that it is not going as per your convention. So it, at one level, our framework, we think, is robust enough to even tell us when to sell stocks. Many frameworks which I have seen over a period of time in my years of experience, and many fund managers as well, those who are stalwarts in the market and those who have spent many years in the market, as well as young upcoming fund managers as well. Many of us are great buyers, but sometimes we are lousy sellers. Okay, and selling is as important as buying in the market. And I feel a framework which also provides adequate sell signals, because everything cannot necessarily be a perennial buy, is my view. And therefore, if it provides the right kind of signals for selling, then then that adds to the robustness of the framework. So we would like to think that the framework that we follow at Invesco has that ability to even give us the proper exit signals or the sell signals as well. So it guides us through the process of initiation of the idea. It helps us to track that idea so long as that idea is in our funds, and it also gives us the exit signals in order to make sure that we are able to exit stocks at the right time as well. But overriding all of this, what we have discovered that our framework does the best is avoiding accidents. So we are able to probably, we would like to think that the robustness of the framework comes from the fact that a good number of accidents which have occurred, especially in the last 2, 3, 4 years, and it keeps happening all the time in the market, we have been able to avoid. And that is the beauty of the framework, that it avoids accidents at one place. And avoiding accidents, believe me, is more than half the job done. If you can protect money by not having some of those accidents, that itself will contribute to a good part of your alpha. Maybe half of the alpha can be generated only by avoiding mistakes and avoiding accidents, and the other half can be generated by getting a few ideas right and buying them with great conviction. So I think that is what I would like to think is our framework. Our framework is therefore to that extent a lot more robust and holistic in nature.
So, at AIF and PMS Advisors, we are developing a sort of a tool where we can compare one PMS with another. So while doing so, I observed that some of your PMS strategies, especially RISE, has shown very significant amount of improvement during this COVID time when the market was bouncing back. So would you be able to throw some more lights, particularly on the strategy?
Well, so because we basically, as I said, our framework is in a position to actually identify ideas both on the growth curve as well as on the value curve. So that's the added dimension and the attractiveness of that framework. Now, the strategies that we run on the PMS side, the principal strategies that we run today are which are called RISE and DAWN, DAW and DAWN. These are the two principal strategies. Now, both these strategies actually, in a unique way, are actually value-oriented strategies. You have sold a lot of PMS in your career, and you've observed a lot of PMS managers and products in the market. But I think you will appreciate the fact that in particularly on the PMS format or PMS platform, there are not many PMS providers who actually give you a value-oriented PMS product. Most products which are available today in the market, at least as far as India is concerned, are growth-oriented PMS products. You will not come across many value-oriented products. So to that extent, maybe we are a little different. We have a unique offering. We think we have an offering which is complementary to the other offerings which are provided by our peers. So RISE and DAWN both are value, and they both ride on a particular theme. They are theme-based products in a way, and we as managers who run things by mandate, we are sworn by mandate. We run each of those strategies in their own based on their own mandate, and we don't change the underlying portfolio or the approach to the portfolio based on what the market conditions, prevailing market conditions are. So RISE, for example, is a product which is based on the concept of operating and financial leverage in companies or in businesses. It buys into companies where we think there is a promise of operating or financial leverage or both materializing in the coming years. And for that, those businesses should have demonstrated certain kind of characteristics in the prior 3 or 4 or 6 years or whatever. Uh, Generally, it is about companies which have, at a very layman level, it is about companies which have, invested a lot of capital in setting up new plants or new manufacturing capabilities, or maybe even bank branches, for example, in a financial services company, and they have not been able to reap the benefits of that investment. So they have put in a lot of capital, but utilization of capital has not happened. Utilization of that capacity has not happened. We all know that when we set up a business, capacity goes up uh, uh, in a big step, but demand only follows gradually thereafter. So RISE is about companies which have undergone a very heavy phase of investment in the past 3 or 5 or 7 years, and then there is an expectation that over the next 3, 5, 7 years they will be able to utilize that capacity and will be able to, if that happens, then the utilization, the return on capital will increase and the markets will reward it, and obviously it will turn out to be stronger growth for those enterprises as well, and so on and so forth. So that is the concept of RISE. And we don't think, to be honest with you, we have done anything extraordinary during the pre-COVID days or the post-COVID days, because the theme drives the decisions in the portfolio. Most of these businesses were based on their investments that they had done last 1 year or last 2 years or whatever that time would have been, by and large all pre-COVID. So uh, we and they were delivering on that promise. So if you go to see our portfolios and the underlying growth of those earnings, growth of those portfolios was exactly in line with our expectations, even though the economy was not doing well and the markets were not doing well at many points in time. But our portfolio constituents were doing, by and large, what was required out of them, which is that they had made investments and they were gradually starting to get the benefit of those investments over a period of time. So what we did only in COVID, if to be honest with you, is that we sat through. Had we not sat through, because we faced a lot of damage as well, especially in the month of January to March, or let's say February to April, when by and large the markets were down, but we suffered more because it is a product which is oriented to the business cycle and the economic cycle, and the economic cycle was turning adverse. Uh, but as soon as the economic cycle started to look a little better in the minds of the market, these companies came back very vigorously, and that was simply because the underlying premise was already valid and they were doing the right things even pre-COVID. So it was we don't have a choice but to manage these volatilities, or control these volatilities, or disregard these volatilities sometimes for the larger benefit, and just sitting through our conviction and sticking to the theme of the mandate made sure that the product came back, and it came back roaringly well in the last few months. So this product, despite being a value strategy in the last 3 years, has done pretty well for itself, I would think. And as I said, this is a product which is a little uh, geared towards an economic recovery, and we have not really seen any strong economic recovery in the last 3-4 years, during which time this product has been in existence. But yet it has outperformed the market, yet it has done a reasonably healthy double-digit CAGR return over that period of time. So we feel confident that we're doing the right things. I mean, it may not be a blowout performance, but we have done the right things, and it's a reasonably a decent outcome under the circumstances for a strategy which is value oriented. As I started off by saying, these are value oriented products. Value has not done well, not just in India, but across the world for a very long period of time. In a growth oriented market like India, a value oriented strategy like RISE, or maybe value oriented strategy like a contra fund on the mutual fund side, has delivered reasonably well. But it's not because of any great, it's not because of one individual or anything else. It is again coming back to the fact that we've done this in a process oriented manner. We followed the process. We've kept to the discipline of doing what we have kept doing. It is like a machine. We put the right input, we know what output we'll get. And so long as the machine is working fine, there's no need to change anything. We know that we have been doing this over the years. If I put X raw material from here, I will get Y output from here. So the machine is fine. It is doing the right things. It has done well in the past. We don't have any reason to believe that it will not do well in the future as well.
So we'll take a short break and come back. While we come back, we'll try and understand more from Mr. Taher. What is their outlook of the equity markets? Thank you. So last question from my side. Taher, by Nifty and the life beyond 11,000, where are we headed? What is your house view?
Well, so I mean, if you had asked me this question a few 3-4 weeks or maybe 6 weeks ago, and I did speak on some platforms and a few times in the media as well, and at that time I felt that there was a decent amount of there was a good possibility that we could play a catch up in the market, and India had kind of underperformed, and we were also trying to come out of the lockdown and so on. So there was a risk on kind of market, and we could see some decent returns. And uh, uh, market since then has done quite well, I would say. But maybe now it is perhaps a little beyond my own expectations for at least the duration in which this rally has happened. So clearly, if you ask me from a very short-term oriented perspective, if you tell me what about the next 2 months, I would like to think that look, we have done what we are supposed to do under the current environment. Uh, the environment has been tough. The problem that we are all confronted with, which is the pandemic, is not something which is small. It is a big problem, we all know. And the worst part is that not many of us have any clue. I mean, most of us don't have a clue about how to deal with this. We are all experimenting at one level, whether it be the governments in different countries, whether it be health practitioners, whether it be pharmacy companies, whether it be people who are trying to develop solutions around it, medical solutions around it, whether you think about administrators in different countries, whether you think about fund managers, whether you think about investors. Everybody are in their own way, in their own life, is trying to experiment, because nobody has a clue. Nobody has come across this problem ever earlier. The last time this pandemic happened of this kind of a scale was 100 years ago. So obviously, it is not an easy economic environment, and it will probably take a fair bit of time for things to settle down from where we are today. And in such a scenario, if markets are almost 10% or little less than 10% lower than their peak, it does tend to tell you that look, we have kind of overextended it in the short term. I mean, I wouldn't therefore want to say that I'm also not of the believer or in the camp that says that look, we will go back to those dark days that we saw in the month of March. I doubt that will happen either. But so clearly, the market is out of its point of maximum fear. That is clearly behind us. But it has also done a fair bit in the recent past. So I don't have a choice but sitting out here today, and what I see around me, I think it would be nice if the market spends some time here in a slightly narrower band, maybe the next say up to 10% plus minus 5% on either side. If it kind of spends its time here and consolidates, and till the time we get better clarity about livelihoods, income, the way the economy is going to open up, I think that will be a good foundation for the next set of rally to happen in the market. But having said that, I also feel that once the lockdowns lift and the economy normalizes, perhaps 2 quarters from now, I think India will perhaps have a slow recovery, but India will get that additional boost out of a global recovery for sure. And the global recovery is probably going to, in my mind, be stronger than an India recovery. I think globally, particularly countries like the US and China are far better placed. They were better placed even before the pandemic happened, and they are even better placed with regard to their own economies, their banking systems, their their credit growth, their ability to stimulate their economies, they are on a relatively stronger footing. So once the pandemic-related issue subsides over the next 2 quarters, I think US and China could probably have stronger recoveries, notwithstanding the confrontations which are going on, etc. But in general, I think the economies there independently should do well, and that should, at some level, have its rub-off effect on even emerging market economies like India. But India on its own probably will take a little longer because we have some of our problems which are a little more deep rooted, and therefore it might take a little longer for that to change. We will get to a normalized growth of that 4-5% variety that we were having pre-COVID. But to get that additional 2% kicker, I think that will come if the global markets do well. So beginning 21-22, there is a fair chance that Indian economy too will do well. I think the one thing, the couple of pillars on which the economy still looks strong is one being the fact that interest rates in India are finally coming off, and they are not only coming off in terms of policy rates, but they are also coming down at the ground level. So transmission of rates is happening. We have as investors and fund managers, we have been debating India's interest rates for now the last decade or maybe even more, and we all know that India's interest rates have always been high compared to most other countries in the world across everything. I mean, generally our interest rates have been at a higher end, but finally now India is having rates which are softer, much more comfortable, and this can change things quite rapidly for India. So the good part is that interest rates are falling, and they're falling as a consequence of inflation being under control. Um, and I think if that sustains, then that's a very good and healthy sign and a very important pillar of India's economic recovery going forward. The second thing, of course, is that our rural markets are kind of recovering pretty well. They from the pandemic syndrome, they were relatively less affected. Many of the things which are falling in place for the rural markets, the rural story was getting stronger even last year, and it got even more stronger after the COVID affair. We're thankful that we are probably going to end up with a better monsoon even this year. So there's going to be a second year of good back-to-back monsoons. Plus, all the economics around the rural market are looking pretty healthy. So I would think that these two factors, interest rates and the support of rural India, should enable a faster recovery for India. But I think global economy should obviously do much better, and then India will do well on some of the counts, but it will require the support of global markets and global economies to do better. So that is how I see it. So from a market standpoint, therefore, if this recovery is to happen, I don't see a scenario where we will see a significant correction, particularly given the fact that there is a significant amount of liquidity support which has been there and which has been provided by administrations and monetary authorities around the world, and they are still on standby. They can still do a lot going forward. Maybe they will spread it out over a period of time. They will see the evidence and the results of their first stimulus, the earlier stimuli that they have provided, and they will be on standby to provide more as well. So I think so long as there is policy support, and that to my mind also therefore becomes the biggest risk to the market as well, that the risk to the market is any kind of policy relaxation. So if at all central banks around the world make a decision or come to that conclusion that the global economy is now fine and it can be on its own, and we can withdraw support, etc., then that could become a risk. So policy error is the key risk which the markets face today more than anything else. And but I'm quite sure that monetary authorities around the world are reasonably clear about what they want to do, and they understand the extent of the problem. So the support should continue till the stage comes where economies are able to stand on their own. So I would like to think that liquidity support will be strong, and gradually as the economies around the world recover, markets should develop more legs. But for that to happen, given that valuations have run up, it is better that we spend some more time here, wander around a bit around these levels for the time being, have some time correction. Then we can think of the next leg of the growth story kicking in, perhaps over 2021 and 2022.
Yeah, so thank you so much, Tahir Bhai. It was a pleasure interacting with you. let me share my experience. Whenever I had spoken with you, at least I got many wisdom to learn from you. So thank you so much for taking the time out from your busy schedule and coming and interacting with all of us. I also would like to take this opportunity to thank your Pune team. I think without their support, organizing this session would have not been possible. So my special mention to Sudhanshu as well.